Stocks are rallying, bond yields are climbing, and the next big test arrives with the monthly jobs report. American equity markets have had a strong run in recent sessions. Indexes are elevated, and investor sentiment looks broadly optimistic. But that optimism comes with a catch. The higher the market climbs on good feelings, the more sensitive it becomes to data that challenges those feelings. The jobs report is exactly that kind of data. Here is why it matters so much right now. Employment numbers are one of the clearest windows into the health of the economy. But more than that, they directly shape expectations for what the Federal Reserve does next with interest rates. And right now, rate expectations are everything. The report covers non-farm payrolls, the count of jobs added across most sectors of the economy. It also includes the unemployment rate and wage growth. Each piece carries weight. Together, they tell the Fed and the market whether the economy is running hot, cooling down, or somewhere in between. Wage growth gets particular attention. Faster wages are good for workers, but they can also feed through to higher prices over time. That keeps inflation elevated, which gives the Fed less room to cut rates. So a strong wage number is not simply good news. It is complicated news. Bond yields have already been moving in a way that signals caution. When yields rise, it typically means investors are pushing back their expectations for rate cuts. Higher yields make borrowing more expensive for businesses and households. They also make bonds more competitive against stocks. Investors can earn more just by holding government debt. That tension has been building even as stocks push higher. If the jobs report comes in stronger than expected, more hiring, lower unemployment, faster wages, investors may scale back bets on near-term rate cuts. That would likely pressure both bonds and stocks. If the report comes in softer, it could revive hopes for easier Fed policy and give equities fresh support. Either outcome moves markets. That is not hype. That is the position the Fed has put investors in. Every major data point now feeds directly into the rate calculus. The underlying question is whether the current rally has solid economic footing or whether it is running ahead of the data. Investors have been pricing in a so-called soft landing, a scenario where inflation cools without unemployment rising sharply. The jobs report will offer the clearest read yet on whether that outcome is still plausible. Watch the wage growth line closely. That single number may carry more weight than any other figure in the report. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.